So I think some of those improvements will improve the speed at which you can connect the megapacks to the grid.
Thank you. The next question is from Mark Delaney from Goldman Sachs.
Yes, good afternoon. Thank you for taking the question. Do you still see 2 million units as an upside case for volume this year? And is the gating factor for reaching 1.8 million or 2 million units in 2023 still supply chain, as was mentioned on your last conference call, or is it more about demand at this point?
Well, if you have a crystal ball, you can lend me back to the crystal ball situation. These are volatile times. From a production standpoint, if things go well, we've got a shot at 2 million vehicles this year, but that is the upside case, and we feel comfortable with 1.8, and we'll have to see how this year unfolds.
That's helpful, thanks. And then the company had spoken at the Investor Day and then some of the past conference calls about opening up its vehicle charging network. Can you speak to some of the feedback you've been getting from both Tesla owners and non-Tesla owners, and how the ramp of the charging network may progress from here? Thanks.
Drew, you want to take that?
Yeah. So as you may have seen, we opened our first V4 post in Europe and our Magic Dock post in North America in Q1. And that is, indicative of the direction we're heading with, universal compatibility for all vehicles of, no matter where the charge port is, et cetera, in all major markets. And we're going to continue to roll out those sort of improved offerings as we build new stations. We're always balancing like our ability to serve our own customers with our ability to serve new customers when doing that. I think we've been able to balance it rather well. For example, in Europe, 50% of all of our supercharging stations are open to all EVs, and we've been able to do that without any increase in wait times at all for anybody. So we're going to continue to take a similar approach as we do this in North America and China over the coming quarters.
Okay, thank you very much. Let's go to Rod Lache from Wolfe Research.
Hi, everybody. I just wanted to first just follow up on your comments in your letter about leveraging your cost position as others struggle with unit economics, and also taking into account the lifetime revenue, actually in a way that most other automakers will never see, just given your service network and supercharging and other attributes. Can you just maybe give us a sense of how far you'd be willing to take this? Are there brackets around the range of initial margin that you'd be comfortable with? And again, any color that you might provide on the updated range of margins that you'd expect in the auto business?
I think we may have answered this question or tried to answer this question a few times, but it's difficult to say what the margin will be. It depends on what the macroeconomic environment is like. So for example, if the Fed were to lower the rates, that would be super helpful for demand. If they raise them, that just raises the interest cost that buyers have to pay to buy a car, so it reduces affordability and therefore reduces demand. So it's, but if we look past, say, this year or like go sometime next year, middle of next year or something, I think things are looking really. I think like I said, all bets are off if there's some major geopolitical wild card that turns up. But in the absence of that, I think I would be very optimistic about middle of next year, end of next year.
Yeah, and just to add to Elon's comments, just two other points. What's really important for us this year, in addition to just managing the day-to-day of the business, but is also investing in, as Elon mentions, what 2024 and 2025 will look like. And so, using the cash generated from the sale of products today and reinvesting that, this is very important for us. I think that what happens to margins over the next couple of quarters only matters in the context of what that means for our ability to reinvest into 2024 and 2025. And we have a lot of space before that becomes something that we have to revisit our investment plans. And so, we're planning to keep the business healthy. But I just want to caution folks about reading too much into what happens over the near term here, because we're very focused as a company on making sure that when we exit this macroeconomic situation, this company is positioned in the best possible way.
Yeah, exactly.
Just to elaborate on that point, though, the revenue, the long-term lifetime revenue that you're targeting from each vehicle is massive. So if you took that to the extreme, it would seem that you'd be comfortable with a relatively low initial margin. Am I
Correct.
misinterpreting that, or is that exactly right? And just
That is exactly right.
Okay. And the normally in a recession, when consumers feel less financially secure, actually price elasticity deteriorates. Just based on your pulse taking of the consumer, do you have a view on elasticity of demand?
Well, I can't emphasize enough the whole just fundamental question of affordability. For most people, their ability to buy a car is a function of can they make the monthly payment or not. And so like I said, if interest rates are really high like they are right now, then in some cases people can't get a loan at all. So it's and I think probably banks are pretty not leaning forward in providing loans. I expect these days. So so that's but like